Good afternoon, everyone. Welcome to the FX Hour. For Shadow Trader, I am Blake Young, here to discuss all things Forex for the next hour. As we look at some things, we're going to talk about some of the things that have gone in intermarket analysis, but we'll also try to get into as many pairs as we can in the time that we have. So I want to welcome everybody out. Remember that tomorrow is tax day, so maybe after this session you may want to get onto that if you haven't done so, or make sure you file those little extensions. That's always fun. But remember, you can follow us at MyTrade. Go to MyTrade. Follow all the Shadow Traders there. You can get the updates, newsletters, calendars, etc. that we provide there, as well as the daily commentaries and the chart setups. So some chart analysis and setups that we watch as well. This is recorded and will be available through shadowtrader.net under archives under FX Hour. All right. Well, with that, let's go ahead and go right into the charts. I'm going to share the S&P chart. We'll zoom in. I think this is the right one. Let's try it. Yep, that's the one I wanted. And this will clean up the image quite a bit, because then we'll just be looking at only the chart. If I can get it to expand out like it's supposed to. There we go. So you should be able to see the S&P chart now. And right where we're at. All right. Yeah, and I'm sure if you are an active trader, like many of you are, if you're sending in information that has a bunch of brokerage statements or a mazillion active trade moves in the year, it might take a little longer for them to get back. And also remember as well, do not. This is my little side note, and then we got to get right into the markets. Remember, the IRS will not call you. Okay, the IRS will not call you to begin a conversation. If they've already spoken with you via mail, or you've called them, or you've sent them faxes, or they've sent you a certified mail, or you've received a notice, or you've begun a procedure of a review, then they will call you. But remember, if you ever get a phone call from someone claiming to be the IRS, it's a scam. Be aware of that. Yeah. So I've been in taxes for 15 years. And have been an RTRP and was preparing to be an enrolled agent, so just be aware they don't talk to you that way. They always send you a letter first or come out, yeah. All right. So let's get into this. Equities were getting clobbered early in the morning. We actually saw a major sell-off, and so we see the market selling off. We saw it breaking back below the previous trend resistance. We saw it fall down to these levels, and then we rallied back up, and we've created this candle. So this candlestick pattern, what is it? As we're looking at this candle, no, that is not my web address. If you're looking at this candlestick right here, what is it? There's a lot of people that would look at this and say this is a hammer. And I'm going to ask the question, or propose the idea, that if this was previous resistance that confirmed itself as support, that confirmed itself as resistance here, then as we're looking at this, if I draw this as horizontal as I can get it to go off of those other closes, then what we've done is we've created a tweezer type top, and then this could be a hanging man. We don't know if it's a hanging man or a hammer, but before we know anything, equities either going to have to clear today's high, and even better, yesterday's high, to be bullish, or clear today's low to be bearish. So as we're watching this, we are in between this widening expansion after we broke through the resistance. We're showing uncertainty but bullishness by the end of the day. And 212, you're right. The word and term hanging man is supposed to sound bearish. And so when you see this bearish tweezers followed by this kind of candle, yes, it looks bullish from the short term, but if we still haven't cleared resistance, this could be a hanging man. It could be bearishness. And that is showing weakness, or at least showing that there's sellers set up in this area, that they've been able to hold it down. And the sellers tried. So the sellers were set up here, the sellers tried down here, but buyers pushed it back up. And a lot of that was driven, I think, because of people looking for a safe place to be. This week, earlier, actually yesterday, was it yesterday? It was yesterday. It's been a long 24 hours because I always end up getting all the family and friends returns in the last 2 weeks that I have to get through. So that being said, the last 24 hours seems like a very long period of time for me right now. But we saw yesterday morning that the Greek or the German bonds went into the negative. Negative interest rate, negative return or yield on those bonds. And so people are looking for a safe place to be, and they're looking for something they're willing to take a smaller return. And as we're looking for that, and we're looking for that smaller return, they are looking to U.S. equities. They are also looking for the U.S. bonds as places to be as well. And you can see the bonds found a base yesterday, but not enough to get real bullish. Today they broke out higher, but not enough to change and push through these annual highs. Remember, this gap is not really there. That was the change of contract. So we're going to change this to, as it says here, the ZBM5, so we can see what this chart looks like without the gap. So looking at it without the gap, you can see we are near these resistance areas right through here. But when we adjust it to the contract, we're not at the annual highs. We still have upside movement. We are trading sideways between this 162 area and about 166, 167. So we're trading sideways through here, but it is a bounce. And so rising bond prices, we'll do the same thing on the 10-year. Rising bond prices on the 30-year, rising bond prices on, we don't have as big of a gap here, so it's not as critical to adjust that contract. But rising bond prices mean falling yields. So this could tell us that we're looking for cheaper rates to borrow. We've been kind of stuck in the sideways move. And this is cheaper rates to borrow for not just institutions and those corporations, but I've told you this before, the 7-year bond auction is what drives the 30-year mortgages, and the 10-year bond auction and the 10-year treasury yields are also very, very close, within a fraction of what you would expect from the 7-year, and therefore you can simply add 175 basis points or 2 percentage points, up to 2 percentage points to this number, and it'll give you a pretty good idea that 30-year home rates are between 3.65 and 3.9%. So as we're looking at this, and we're looking at these moves through here, yields are low, and theoretically we should be seeing growth. Well, we saw some growth. We saw retail numbers come out, and everything I saw in the news, everybody's saying, look how great retail sales were. Look how great and phenomenal everything was. And yet it still missed analyst expectations. It is the first time in 4 months that it is positive. That's surprising. We have not had a negative that long since 2009, since the crash in 2008 and 2009. We have not seen 4 months in a row negative. We haven't even seen 3 months in a row negative. So this 4th month coming into the positive, that was very similar to what we saw at the end of 2009 and going, or better said, mid 2009. After we saw the crash in 2008 and 2009. So that 2009 time frame was the last time we saw this, and this was deeper. So retail sales, you would think we're going higher if our yields are low and it means that we can borrow money and it's cheap money, but are banks lending? And that's what we have to look at as we're watching this data. Is our banks lending? Is it really rallying? And yes, we pushed into the positive, but is expected to be 1.1%. We only came in at 0.9%. So I'm not looking at that as an extreme positive, not nearly as much as some of the talking heads were, that oh, look, we positive reports. After 3 months bad, we're now positive. Great. Congratulations. You missed expectations and didn't have 4 months in a row negative. You just had an entire quarter. It is, yeah, and so I am being explicit, right? We're looking at 2009. It was the end of 2009, so that's a good thing. Maybe it's, the recovery of that, but we're still talking about coming out of the hole. That's the last time. 2008, we were down in that negative for more time period than that. But 2009, in 2008, from August 2008, we had 1, 2, 3, 4, I think 5. I'm just looking at some of my data here that I printed out. Yeah, so we had 1, 2, 3, 4, 5, 6 months that had negative retail sales in 2008. We came to the positive for in February 2009, then we had 3 months negative, and then we came positive by June. So we actually went 3 months negative, but deeper than what we did at the end of 2009. Now that's, again, that was the pullback. 2008 was a crash. 2009 was the pullback, as 212 is saying. So let's go over and look at that S&P really quickly again. Then let's look at the dollar during that time frame, because in the S&P, if we go back to 2009. Got to go back 10 years. Let's go to the weeklies. Your crash in 2008. This is where it began. This is where the big crash came down. Remember what we said, that February in 2009, we went positive. Right through here, the retail sales went positive, as did the equity market in January. So the retail sales report in February came out positive. And then we had 3 months in a row that were negative. So by the time we turned the corner on equities and we saw the 2009 go positive again, we were to June, and by then we can see that we're recovering. So could we be dealing with this kind of a correction through here? Not this kind of correction, but this kind of correction through here if we don't see retail sales perform better. And so that is, I'm not trying to be scary here, but I'm looking at this saying, that was a sell-off. How can we look at anything with that many months of retail sales being negative and not pay attention to the fact that that is a negative item? That is not considered a very positive thing. And when we see retail sales negative, we should have had a lot higher retail sales considering energy prices are still at multi-year lows. Here is the crude light. You can see that the price of crude light when we've been between the 45 and 55, we're still there. Just pointing out, we are still between 45 and 55 even with today's rally. I've said that we might stay through there all the way through the summer. A lot will depend on how we do with the inventories here, but this resistance and support area back through here and this area down through here in the 33, the strongest support area, if you look at the closes here on the weeklies, is probably near 37 or near, call it 38. And so we still have room to the downside that we can move to play off that 2008, 2009, but we should be worried if we're playing off 2008, 2009. We're not. We're up about $6, $7 higher than that. If we weren't up $6 or $7 higher than that, if we were toying with 33, that's a problem. That's a major problem to consider that we'd be dealing with energy and oil prices that were down to the 2008 lows. Now, as we're looking at crude light, let's deal with copper while we're here, and then we'll get into some of those currencies. As you can see, copper nowhere near the same lows. Basic metals are still holding up. This is your 2008, 2009 time frame. This is your key support area that we bounced off of that ties to 2007 pre-crash. So I do think this is a valid support area. We are bounced off that support area, rallied up, but I want you to notice that we're bouncing off the previous resistance areas as well as we toy with this level right here. So we have resistance, support, 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 and resistance that we're playing off of the long time frame on copper. So here we are rolling over off the peak. You can see a huge shooting star, or yeah, that's what we'd call it, a shooting star. Tombstone doji kind of thing. And we're going to push that price back down, and it has been pushing down for the last 3 weeks and still showing that we're not seeing that growth. Now, with oil going up over the last week or two, really, I guess if you go off the lowest point, we're talking about going up for 3 weeks, almost 4 weeks in trading. We've done this before. We're near that resistance area. This highest close that we've had going all the way back through the beginning of the year, that highest close we had was 53.24. We are at 53.12. We're going to close below that highest close yet again. We have a higher resistance, like I said, about 55 that I've been watching, and we keep saying it should trade between 55 and 45 unless we see the Saudis change their stance, or if we see Iranian oil and Russian oil come online, then this could fall back down and fall very, very quickly. So as we're looking at for that, let's go to the Russian ruble. And I always forget which one to use here. Let's use... And since it never shows me what I want, let's find... What's your favorite? I'd probably start with the highest volume one, which is the RSX. You can see that after all the sell-off, here's your big sell-off in the Russian economy, and everything was struggling. When they're talking about bank failures, they changed their interest rates. They're hitting 30%. But now we've bottomed out, created higher highs and higher lows, and as we're watching the Russian ruble, or Russian economy, you can see everything is climbing higher and higher. This is only going to go faster, and there's probably some anticipation of Russian oil hitting the markets. Hey, you Fred. There you go. The Russian ruble. So you say API is out? I did not see the API numbers. And yeah, we're back up. So what did the API say? Yeah, and you know, some of the banks that you see, like let's try Sparbank, or Spurbank, however you pronounce that. It looks a lot like what we just looked at on the Russian ETF. You can see those higher highs and higher lows. Now it does seem a little overextended up here at the highs. And as we're looking at that, we look at the higher highs and higher lows, and we see the prices pushing up. And so as we rally up to the $6, yeah, that's a nice recovery off of 3. It's doubled in a matter of 5 months, but we're still way off the top. We're still nearly half of what it was a year ago. Well, and there were definitely some situations where Russia was not allowed to export, and they were not sending as much to the Europe, and so it was diminished in their supplies. So as we're looking at that, when we're seeing their economy start to recover, and when we see things rally, and we're watching for crude light to kick out, and we're watching for them to increase their production, and we're watching as well as in Saudis, and we're watching to see if Iran puts out some more oil. And as we're looking at all these, those are all things that are going to impact this. Now you say API is out, and I still didn't see the API, and as we're looking at that, still not seeing it that big of a deal. So watching these again, crude light still between 55 and 45. I'm sticking with that. I'm still expecting that, and we'll continue to watch for that. But over the last couple of weeks, 3 weeks, 4 weeks-ish, when we see this prices rise, this really hits some of the unique pairs that we don't necessarily spend a lot of time on. And you might look at something like the US dollar Norwegian krone, and the dollar losing to the Norwegian krone. You look at something like the Swedish krona, and you see it starts to roll over as we saw that. The Norwegian is obviously the strongest of those. And we start to see the dollar losing some ground and it's topping out. That Norwegian one is very fascinating to me, though, to see that not only is it a big sell-off today and an engulfing candle that engulfed the previous week to 6 days, but that also sets us up for lower highs. It also sets us up for a breakout of this consolidation. I know I normally don't look at the Norwegian krone, but this is a pretty interesting view as far as the US dollar Norwegian krone breaking out and showing strength to the downside, which means weakness for the US dollar, strength for the Norwegian krone, and that could be some indication that we're going to see a further move in oil, or at least the speculation that's going to help the Norwegian krone. As we look at the euro, we can see that same situation, that directly to the people they export to more, to the Eurozone, we can see we just broke out through this long-term consolidation, this long-term support area today. And if you wanted to go with a little bit higher support area, we'd have broken out yesterday. But this breakout sets us up for this huge triangle. And even if we don't go all the way back to this level, because that is what I would consider a base, if we go to the tighter area right through here as shorter term base, that still has the potential of moving 5.3% or 4,500 pips. Now the Norwegian krone is not worth as much as we just saw there. If you look at this right through here, you can see they're only worth about 13 cents per pip, but still 4,554 pips. That's a significant opportunity, and this is who they trade with. And so we're looking at that and that breakout and that move to the downside. We can grab our Fibonacci extensions and measure off this base right through here. That still gives us an opportunity to move down on that price pattern and hit 81.10, which is the annual low against the euro. And again, like I said, there's plenty of opportunity in there. Just reading through really quickly. Yeah, and we didn't hit natural gas, so I'll go back to natural gas in one moment. And Condor's talking about Ichimoku Cloud and the fact that crude light is closing above that. And I think that's great, fantastic, but I still don't see it breaking out of this, even if it's above the cloud. Did price really rise? This is what I always ask myself with indicators. Did price rise, or did the averages, which includes the Ichimoku, because the Ichimoku is based on moving averages, did the averages come to price, or did the price rally? And as you can see here, price has rallied over 3 weeks, but it hasn't broke out of the same consolidation that it's had all the way back to December. So 5 months, crude light has remained fairly sideways and a little bit less than bullish. It's just stuck. So as we're watching this and we're looking for crude light to break out, and we'll go to the natural gas next. But as we're watching this, looking for this to break out, what we're wondering and need to see is whether there is really going to be a decrease in supply or increase in demand. So we go to natural gas, and we got to hit the pound and Canadian dollar. Natural gas, 252, 1 day off of the annual lows. Let's go back even further. 3 years. We are near a 3-year low. We could go to 230 or 190, but as you can see, we are bouncing a little bit today, but we're just 1 day off of the lows for the year, and actually 2 years. So we're through a 2-year low, and we're just not seeing a lot there. There's not a lot of demand. Now, as we're looking at this and we're watching for price action to change, we're looking for demand to increase, we're looking for supply to decrease. That's true across all commodities. Let's go look at gold. And as we look at gold, you can see gold is selling off. Fear of inflation is not that high. Expectation that we need to protect that is not protect the weakness in the dollar over the last couple of days is not there either. This is showing that we're not fearful of inflation. So as we're looking at this, these are all things we need to take into consideration. So let's start out with the US dollar, Canadian dollar, and then we'll go to the pound US dollar. As you can see, we've fallen and we've gotten this big shadow right back to the same areas of support. At the same time, we're hitting $55 a barrel, or 53 and some change, almost 54. This is what I keep coming back to. $55 a barrel is key for Canada. When they can produce at 55 barrels, they make money. If they can't produce at $55 a barrel, if they're selling for less than $55 a barrel, they have a harder time making money. If they're having a harder time making money, the demand for the currency weakens because they're not going to sell as much oil. Well, we're right back near to 55, and you can see this is coming, or near 55, and you can see the Canadian dollar is strengthening right back to this support area. There is a lot of buyers set up in this area. That also would imply there's a lot of sellers set up at the $55 a barrel. Now, those that are sitting on storage, they may see that $55 a barrel as well. And they may say, hey, you know what? I bought in at 45. I bought in at 48. It's only been 4 weeks. Why would I not be interested in making 20% on my money for 4 weeks of holding it? So as we're watching, we may get a bunch of sellers stepping in on oil at 55 and a bunch of buyers stepping in on the US dollar, Canadian dollar here and pushing this around. As we go over and look at the pound has been able to rally off of the lows after breaking through this key support area, rallying through after that and watching oil prices rise. It's certainly helping the pound, but we still have a lot of resistance up through here on the pound as well, and they're 149.76. So I'm looking at the pound and saying, you know, I don't necessarily want to trade the pound against the dollar. I really like the idea of trading the euro against the pound. So we'll go the euro pound, and this is where we set up that trade yesterday. So we broke out, we took the trade short, and I'm looking for this to get back down near these lows, near 70.66. Remember that the pound is worth more. The pound is worth more than $1 per pip. The dollar is worth $1 per pip if it's in the quote, but the pound has the current value of the US dollar, and that gives us a value of about, what is it, 147.90. So we'll call it $1.48 per pip. So it's almost a $1.50 per pip move. So if we're looking for a move through here, and we're looking for it to get down to 70.42, that's actually our target is 70.42. Then that gives us a move that's about 160, 165 pips from where we're at right now, but that is worth it 1.5 times. I didn't see the lander. Did it land? And so this is what the crazy thing is, money. You know, if that's the numbers, if you're posting the numbers that came out, that's the kind of the crazy thing that we're dealing with right now. Is we're dealing with an idea that, you know, as we're watching the API, that we keep adding more and more and more inventory. So looking at more and more and more inventory is going higher and higher. That is, you would think that would be an indication that we're going to top out. So Crystal, I don't know if you just barely came in, but we did hit natural gas. Natural gas is a 1 day off of its 2-year low. And so regardless of the fact that crude light is near a $55 price level, 53.65, 53.68, you know, the thing with the what we're seeing on natural gas is there's no demand for it, and the supplies are plenty. So as we're watching this, that demand and that shift in supply and demand, there's still an opportunity that crude light will top out. You know, and Cadet, I get what you're saying, but 55 is still a key area for me. I understand what you're saying about a trend line, but as we look at this, we're still toying with the same resistance, the same high close. We haven't cleared these shadows of 54.21, which we've hit 4 or 5 different times. We know there's a psychological barrier at 55. All of that is holding true and still holding true on crude. So I'm not anticipating it to break higher. Now, one of the things I am anticipating to move higher over the next couple of days, not necessarily a lot, but some, to set up for our next potential opportunity is really the Euro US dollar. So we see the Euro US dollar give us a very bullish candle. This is a classic 3-candle reversal. We had a bearish candle, an indecision candle, and a very strong bullish candle. We cleared the high. We're almost closing above the body. This is a pretty strong bullish candle. As I'm watching this, I'm looking for where it can come back and retest. If we look back to the annual lows on the bodies, we can come back something like this, and we can look for those prices. As we look at this close, and do the same thing as we're watching through there. It's pretty close to the same. What I'm watching for is I'm watching for a test of 108.27 or 109.27. Now, it could take a couple of days, a couple of weeks even to play out. If we try to anchor those resistance lines, we'd be down through here and over the next, let's call it by the 17th. So by Friday, we could see price rally and retest 108.24. If we grab the shadows off of that, then I'm not going to be surprised to see that test closer to 109.29. Still putting in a lower high and still setting us up for this longer term downtrend. I still like the euro short. I still want to see the euro go short overall against the US dollar, but we took our short here. We stopped out with a small loss because we added to a couple positions on it. Stopped out one with a gain, one with a loss, so netted out a small loss. And then we should have shorted again at 110.30, but I was trying to get it back up to those highs. We missed it. It rolled over a little bit too quick, and now I don't expect it to get to 110.30. I expect a lower high that will continue this longer term downtrend. So we'll continue to watch this. So as we're looking at the Euro US dollar, and I did get a question about why I treat the other pairs like they're different pairs. I think you may be confusing. I'm dealing with spot generally. And so one of the questions I got in the chat from Nexus is that when we're looking at these, when I talk about the CAD, I'm generally using the US dollar Canadian dollar, not the Canadian dollar US dollar future. So these should be just the opposite. The futures are all quoted in US dollars and based on whatever the currency is. This is quoted in US dollars and based on the Canadian dollar. So this would look like something like this. And so the Canadian dollar has the same resistance area as the other one has support because they're inverse to each other. And so as we look at the futures, be aware there's nothing different in these except they're just quoted backwards. They're quoted all with, well, not always backwards, sometimes it's the right way, but it's simply quoting with US dollar in the quote versus the base. So the base is on the spot currency, and here it has it as the quote. And so the whole thing is just inverse to each other. So as we're watching, it's the same idea. I'm looking for this to hit this level near 80.59 the same time oil is hitting $55 a barrel. And if we see the sellers step in as they've done repeatedly all the way back through January, then I would also be looking for the Canadian dollar to weaken at that point, the US dollar to strengthen at that point, and oil prices to peak out at 55 and roll over and get more bearish. And that's where I'd look for that. And then as we look at the other ones, like I said, I don't think any cross is weird. I think it's just a matter of picking your poison. So as we're looking at this and we see that oil prices are going up and gold is going down, one of the crosses that I'd look at is I'd look at the Aussie Canadian. And the Aussie Canadian has done very well at bouncing off of the support area multiple times. It broke through there, then treated as resistance, and it rolled over, creating a tweezer at the top, bearish continuation. And so now I'm watching for the pair to come back down and test this level right here at the same time that, again, oil probably pushes up to test 55. Now, if we watch this fall back and test the support area, I know this seemed like a little overextension. This seemed like a stronger bounce, so I'm looking for it to only get down to 94.63 and looking for that to coordinate very well with gold and oil. So as we look at oil rolling over and gold getting stronger, this chart should go down. If we see oil hit its resistance at 55 and gold find its support either at 1181 or even lower down at 1146, then I would expect the Aussie CAD pair to bounce. Yeah, there's not that many pips in the Aussie CAD move. I'm looking at the bigger opportunity though. I'm not saying buy it today. I'm saying that these moves off of support and resistance, if we can get a bounce off 94.70, we could get all the way back up to 97 without very much trouble. So there's 230, 240 pips, and it can do that in a matter of 5 days. So I think that's a fairly reasonable move as we're looking at those pairs. So let's go through the futures and the Forex. For those of you that are futures traders, here's the Euro US dollar. The Euro US dollar looks exactly like the Euro US dollar spot pair as far as the chart goes. 106.52. Go back one more time to the Euro future. The difference is the Euro future is a June contract, while the spot market is a 3-day rolling future interbank market. But it's going to give you the same bounces, the same rallies, the same moves, the same key resistance areas being tested. And so I'd be treating this exact same way. We got a bounce here. I'm looking still for a lower high. I'm still looking for an opportunity to sell this. And with the euro continuing their stimulus or their easing policy, then I'm looking for it to come up and create another resistance and to weaken the euro. Remember that when the U.S. was doing our quantitative easing, we saw the dollar weaken a lot, and we saw our equities rally. We saw people looking for some place that they can get an opportunity. So if we're looking for that opportunity, that means that we're looking for equities, or we're looking for U.S. equities instead of the European equities or German equities. They're looking for a place to go. It's what drove the bonds into the negative, is because they have a fixed rate, an interest rate. They didn't change the interest rate. It's zero. But what happened is the bonds were being bought. People were looking for safety. And as they bought those bonds and moved into safety, that caused it to create a situation where they saw a negative or inverse rate of return. So as we look at this, let's go to the pound. Again, we'll hit all the futures quickly. Since, as you say, we're going all in. There's a 6B. Looks like the pound as well. You can see the long-term trend is down. This looks like we're setting up for a new trend. So what I would be willing to do on this one is grab these support areas through here and say, oh, look, I can grab those support areas. That's kind of nice. I like that. Very nice. And so grabbing these support areas, maybe a little bit, trying to clean it up just a little bit. Grabbing this close, that body. I think we can grab these a little bit better, and that looks like a multiple touch. We can get 3 or 4 touches. Now as we're looking at the resistance areas back through here, even though I'm cutting that off, I'm going to edit the properties on this channel, throw in the 50% line, and oh, look at that. That's exactly where resistance was. I've still got a downward trending resistance line, and as we look for the pound to rally up, I'd like to see it test this area as this extends to the right. We'll look to test the resistance area closer to 148.80. If it breaks through there, I still like resistance near 151.12 and the continuation downtrend on the pound. But right now, as oil is rallying, I expect the pound to continue to strengthen and push up to this resistance area. And this is exactly the same thing that we'd expect on the pound over here. And we came back here, didn't we? Hitting as many points as we could. And so I'll be looking for the same type of play on the pound future as it is on the pound spot. So let's do the Aussie. Here's 6A. 6A is the future. Australian US dollar. Aussie actually bounced today, possibly off of retail numbers, possibly off the fact that there's higher demand for some base metals, iron, aluminum, other things, even though gold is selling off. So base metals and materials have gone up a little bit, and that could be pushing the Australian dollar to find a support bounce here. So a little bit of a bounce in the Australian currency versus the US dollar. And the US dollar was down. And it's not just the bounce, the fact that the bounce has happened at a key support area. Here's the Aussie US dollar pair. It looks very much the same. And so anytime I talk about the Aussie or the pound or the euro or the New Zealand, these are all going to look exactly the same as their futures contracts. So nice little bounce there. And basic metals are holding that up there. But if we see a sell-off in markets, and if we see the dollar rally again after today's significant sell-off, then these could break through support and we could see things roll over again. Watch again for that $55 oil price. I'm just reading the chat here. Let's see. So 212, you're not wrong to think that we should have severe inflation with all the quantitative easing. But when we have a significant downturn or failure in of demand of other goods and services, it offsets that weakening currency. So the weakening currencies fall and fall and fall, but then all of a sudden the cost of goods and services fall, and so the weakness of the currency disappears. And that demand and that inflation, that growth isn't there. And so we created kind of a pseudo-stagflation. But you're right, when it does break free, it could be significant. Now this is the 6J, this is the yen futures. As we're looking at the yen futures, the dollar yen is in the opposite side of things, so it's like the dollar Canadian, where the dollar is in the base on the spot market. So this will be inverse. So right now the yen has been weak over the last year, but it has not broken through this support area. In fact, we've traded in the same range, it's a little bit wider range, all the way back to November. If we look at the highs and the lows, we keep coming down to those lows and those highs, and we've really traded flat since November. And if we look at the dollar yen, it's going to be the inverse, so it'll be up at a high, but you'll see the same type of thing. We have a resistance up through here, and we have the support levels back through here, and we've traded this weak trend, weakness in the yen compared to weakness in the dollar, or arguably strength in the dollar and strength in the yen as we hit these highs. Now, we're still in a long-term triangle as well that I would continue to watch. We are right at that support area, so even if we break out through here, I'm only expecting it to fall back to 116. If we bounce and clear this high, then we have an ascending triangle that could be significant. On the yen, that would put us into a breakout to the downside, and that breakout to the downside could take us all the way back into the 70s. Not in the year 1970s, but the inverse of this, which is going to be, let's go ahead and measure it. We'll go off this point. I'm just going to grab my Fibonacci extension just to measure it as a price pattern, as a triangle. If I measure it as a triangle from here to here, and measure that as a breakout, that gives me a topside target of 128. So looking for a move up to 128, the inverse of that would put you down into about 70 cents to 100 yen on the dollar. All right. Lots of comments, lots of chat. And GFC and Trader, the light blue is very hard for me to see, just so you know. Yeah, we should know on crude light tomorrow, because crude light is either going to break this 55 or stay below it, right? And there is a lot of geopolitical pressures in oil, not just global demand. So looking at the S&P one more time, going back here, you can see we've commented on this, that we hit resistance, created kind of a tweezer top or an engulfing pattern, then we created this, and whether it's a hammer or a hanging man, that's to be seen. I think you could draw a line in the sand right now and say a close above this high, close above 2101, puts us back into a bullish trend probably for the next month. A close below this low puts us into a downtrend, at least back down to support 2040, if not lower. Both of these set us up for the late May potential selling. So are we going to push higher one more time before the sell-off, or are we going to drop down and break support going into the sell-off? And that's the big question. Okay, so even though we had inventories increase, the overall stockpiles fell by 4.1 billion or million barrels, and that's causing some weakness in the crude light as well. Yep, and Royal, I won't disagree with that. I just got to get it above 55. And we were inches from here, and here, and here, and here. So we've been here before. It's got to clear it. Right? It's got to clear that resistance area. And 212, you're right on the board. That's what I've commented on multiple times. They are incentivized, the central banks are incentivizing, or the reserve banks, or the regional banks, excuse me, are being incentivized to not lend money. Now, it's not directly, it's kind of. Because what they do is they say, hey, you know what, you got slapped around before, so what we'll do is we will incentivize you and pay you to keep your reserves above a key level. If you keep your reserves above there, we will pay you about 1.5% to 2% on excess reserves. Now, if they have a choice of lending to me on a mortgage or lending to me on a car loan at 2.8% or making 2% from the Fed, who are they going to go with? Which one's a safe bet? Which one, as a banker, and you have to think like a banker, and bankers are incentivized to reduce and eliminate costs, or not costs, but risk. So when we're looking at that, if they have a choice of 2%, yeah, me, 2% from the Fed or 2.5% from me, they're going to go with the sure thing. 2% sure thing versus 2.5% from a schmuck like me. So that's always going to be the case. So they really are incentivized to sit on the money. Now let's go through let's go through the yen pairs really quickly. I've got a number of requests on the yen pairs. One of them is saying, can we look at the yen with the market forecast? So first off, we'll notice that this candle could be setting up for a higher low on the long term while we're still in these lower low patterns. The market forecast is a proprietary indicator to Thinkorswim and TD Ameritrade, InvestTools indicator. So if we throw in the market forecast, currently it is showing bearishness. See how it peaked out yesterday and rolled over? The green line is bearish, the blue line is bearish. The little bounce in the red line doesn't mean a whole lot. Not when the green line and blue line are falling. So based on that, this would be a bearish indication. And we have these lows through here when we go off the bodies that match up to these lows over here. So everything is kind of matching up off of that support, off of that support, off that support, and then we bounce today, creating a hammer. So from candlesticks perspective, it looks like it's holding up a support. From the indicator, it looks like there's some more bearishness in this, and we could be setting up for lower highs and a breakout. Remember, the Aussie yen is one of my favorite pairs to watch to determine whether the markets are going to go up or down based on its key turning points, not necessarily on its up and down from one day. But if we break support here, I would expect the S&P to reject resistance on its chart, at least, if not break support as well. So we're watching this right now. If we bounce and rally, that means greed is good and fear is waning, and therefore I'd expect equities to clear the high. So watch this pair as well. If we get bounced tomorrow, watch for the equities to clear its high. If we break through the support level tomorrow, watch for equities to reject resistance and fall down and continue to drop from there. So let's look at the New Zealand yen, CAD yen. We have actually a pound yen and a CAD yen trade going on. So here's the New Zealand yen. There's your, oops, if I can anchor it, anchor. Close enough. We had some consolidation. It looks like it broke out and now is retesting based on the multiple touch support area from the short term. From the longer term, I don't know how we can anchor it without having it be a breakout, but from the longer term, it looks like it's a breakout already, and so I'd expect it to be falling back down to longer term support, which would be taking us back down to 86. Now, this little bounce, again, is experiencing bearishness in the indicators and bearishness in the chart, and if we're expecting volatility to go higher, here's the VIX. If we expect volatility to go higher again, then we would expect the yen to gain strength as the short covering of yen strengthens again. Now, this gap up and close down, that's very reminiscent of what we saw in equities. We saw the market sell off and then rally. Well, this gapped up to start the day and then sold off, and that volatility is coming back down to support. But another rise in volatility would probably cause the yen to strengthen. We are currently in 2 yen short positions, and that is on the pound yen and the CAD yen. And so the pound yen sold off initially. Well, we got into the trade here, sold off, rallied, sold off, rallied, and we're back into the positive. We're actually above our entry point just by a pip or two. So here we are looking at this bullish move. Can we get back above resistance here? If we get back above resistance near 178.82, I'd be willing to add to this and look for that swing all the way back up to 184. But that is going to require lower volatility. Watch for equities. If equities break through the high, again, volatility will remain low and this pair goes higher. Add that to the fact that if oil breaks through 55 and volatility falls, this should have no trouble getting to 178, 181, and back up to 184. The CAD-yen is very similar. They're going to behave very similar to one another. So as we look at the CAD-yen, this one we bought on a Fibonacci breakout. We've moved up our stop right about to here. So we're still looking for this to get back above our entry price. And in spite of the fact that oil prices are rising, and in spite of the fact the Canadian dollar has beaten up the US dollar, it hasn't beaten up the yen yet, partly because of that higher volatility. So watch the volatility. That's going to be key. Watch equities and watch the volatility. Today was not enough to break us out. That is not enough to get us to move to the next level. How would the Fed weaken the dollar now? Right now, they just say that they'd have to take off the discussion points that they're going to raise rates. That would, one, cause the dollar to weaken. That's all they'd have to say, one. But two, if they really wanted to weaken it with some monetary policy other than just verbiage, then they would start discussing and possibly lean back into some quantitative easing. We're at a 0 to 1 or 0 to 0.25% rate, and so that could be an indication that would cause that to weaken. Right now, they keep saying that they're not overly concerned, and that's what you have to watch for. Are they really concerned? Are they going to change their verbiage? Are they going to push out that rate hike until later? Let's go look at their rate hike really quickly. As you know, we can go to the trade tab on that. And I have to switch charts so you can see it. Nothing really changed here worth discussing, but I want to make sure everybody knows how to do it. So we do this every week. All you do is you come up to the trade tab, type in your ZQ, that's the Fed Funds Futures, hit ZQ. Make sure your futures are set to all, because I usually just try to do the drop down, but it's easier just to go to all. So as you look at this again, we take 100, subtract off this level, and that's the current rate. As you can see, August, we're at 99.825. That's the current rate as well. We need to see this get closer to 99.75, which we're priced to September, or now maybe a little bit closer to October. We're about halfway. The bets are almost equal, September versus October. As you can see, it's almost equidistant from that 7.5%. Now, as we look for the second interest rate hike, it's being priced in all the way out to February. As you see, 99.54 right through there. And that's really where we're seeing markets bet. They're betting on September, October for the first rate hike at this point, and then potentially all the way to February for the second. So they're looking for at least a quarter to 2 quarters apart. Back to the charts. Oops, is that the right one? Yep, that's what I want. All right. Yep, Australia is extremely dependent on metals. We generally watch gold, but we are been watching more base metals. I'm saying crude light hits resistance. I'm not saying down. I'm saying it fails at resistance is what I'm watching for. I'm watching to see if this fails here. Now, the inventory numbers could throw it off. I can only be right so long on this, right? We've been right for 4 months now, going on 5. And so as we're watching this, if we're right 4 or 5 months and then we break out, I'll be wrong at some point. Be aware, it'll break out through 55. It'll break out through 55 at some point. Hopefully while I'm still doing these FX hours. But at this point, I'm still watching for resistance at 55 to hold. That's what I'm talking about, holding at that level at least. And then if we see more inventories increase or we see more demand numbers showing that we're still slowing down, then I'd expect this to roll over and fall. Green line is my primary indicator when I use the market forecast. That's all I'm getting at with the green line. And then I watch the blue line for divergences. So the green line is rolling over. And coincidentally, green line is rolling over even on crude. Crude peaked out at 82 On the green line, it rolled over to 79. That is a bearish trade signal initially. Actually, nope, I take back what I just said, because today it's pushing back above 80, and anything above 80 is bullish. So depending on how this finishes here, looks like it may be done. But depending on how this finishes here, that could be an indication that we are potentially getting strong enough to be bullish. We might be able to break out, but I'm still watching for 55. I'm still watching for those areas to hold up at that resistance area. All right. I'm just reading the chat here. All right. EUO for the euro degradation, and that really still ties to the same thing. It's EUO. Now this is your ultra short. It's an inverse to the euro US dollar with 2 times leverage. Remember, the currency market is 50 times leverage, so this does show weakness of the euro, still shows continuation higher. Today's a gap down and close up. That's still because it's only trading on the US markets. You're going to get a cleaner chart. Actually, I love the ideas and the concept of simply watching the euro US dollar and paying attention to the technical analysis, because it is a full 24 hours. And we're watching that 24-hour time period and then using that to determine what to do with the EUO, but obviously doing opposite of the EUO. Yeah, and I would expect further euro degradation. I said that already. I would expect this to go all the way down to parity, even back down to 85. It's just a matter of waiting so I can sell at the resistance area and looking for that to fall to the next level. So the problem with GE, I actually had a question of whether GE is really going to have this impact, and with it, where they sell off their assets, and what's that going to do to the dollar. The fact is, the buyers are generally in the U.S. already, so assets just switch from one company to the next. It's internal, so it won't really have an impact on the currencies. It's certainly being used for a buyback, which stimulates the purchase of GE. GE was so flat for so long right through here. That is, that move right through there. We probably just shift everything higher and let it play out the same kind of consolidation, just everything shifted up about $2. So, $2 is 10% more higher, and then I'd expect everything to go sideways. The interesting thing to me is, if they're selling off real estate assets, is that telling us something? That's probably the bigger question for me. I am sure they have some of the most brilliant minds in the industry helping them analyze the risk of the markets and the risk of their portfolios. So as we're seeing home builders stop at these highs, and we're seeing that the Fed is still talking about raising rates, if we're stopping at the highs already with record low commodity prices, with cheaper labor than it has been, with interest rates at 3, 5, and 10-year level lows, making it should be the strongest market out there, and we're stalling, are they stepping away from their real estate holdings on purpose? So this tells me this situation, that we may be dealing with something that is more of an indication that they are afraid of the risk associated with real estate. And it would make sense. To me, anyway. There's a lot of questions here. Coffee. You wanted commodity prices, and specifically coffee. Coffee's still stuck in this range down at the lows. This indicator right through here. All I did is, it's an indicator. This is an indicator that just adds 80 and 20 lines. That's all it is. It's a market forecast. I've just put in 80 and 20 lines, static 80 and 20 lines, Bill. So there you go. Chand, I don't have time to go over the market forecast today. Normally, I easily can spend an hour explaining how that indicator works. And that's, an hour is a compressed time for what I'd like to do. So I would just simply say the direction of the green line outside of the reversal zones is your bias. Upper reversal zone is bullish. Bottom reversal zone is bearish. And so I really won't be able to take enough time to do that on the market forecast today. We'll do it another time. We'll spend most of the time on another session, but I've only got 4 more minutes, so we'll have to hold off on that. Yeah, so 2 and 2. If the oil goes down, the dollar gets stronger again, and we push the dollar higher yet again. Euro dollar and all these currency pairs really trade around the clock from Sunday afternoon till Friday afternoon, and there's some dealers and brokers that let you trade it over the weekends as well, just higher spreads. And I just sent that script there. If you click on that, that way you can have the 80-20 lines. And as we're looking at this, Dow's talking about the cattle leading the ags. And as we look at the cattle, you can see cattle is bouncing already. Live cattle futures. And the bounce is a key support. There is a little bit deeper support that we can certainly find down in this area, but we did get a little bounce there. As we look at general ags overall, they look a lot like coffee. We're down near those lows. We look at wheat, down near the lows, down near the key support areas through here. We look at corn, down near the lows. So a lot of similarities. Now the question is this little bounce, this harami, is it going to follow, like you're saying? Is it leading it? That we're already turning the corner here on cattle and that we're going to move higher. And there can be some leading and lagging in there. We know that would be probably more indicative if we're looking at New Zealand, as they do a lot of cattle, both dairy and beef cattle. As we're looking at this, we would expect them to strengthen if that's the case. So the New Zealand could be still an opportunity through there. Yeah, Dow knows you've been here enough that I've been waiting for the ags to stop being weak. I like the idea of ags finding a base. They seem overly cheap. And like I always say, you can't eat gold. And at some point, no matter what happens, no matter what we stop buying, no matter how much decrease in demand we have in everything else, at some point, with the weather patterns and the changes that we've seen in the global climate, and the things that we're seeing, with the droughts in California and floods in other areas, that we know that we have a situation where agriculture prices has to stop falling, and because we will continue to want to eat. Eating and drinking water and breathing. If I stop doing any of those 3, that'd be the worst business decision I've ever made in my life. So we'll keep doing that, and that's where I'm looking for this to find a base. And then if we do find a base, New Zealand could strengthen and maybe start leading out the pack, because it still has some interest rates that it can work with too. All right. Just really quickly. And saying coffee, Brazil crop forecasted improvements, and that could be part of the reason why it's down. But wheat and corn as well is down. And the nice thing about being in the global market is even when we have California's drought that's impacting our agriculture, we know that that's not the same situation that they're having in Australia, New Zealand, even Mexico. They're not having the same kind of drought situation we are. So therefore, that's part of the reason why we have agriculture prices globally staying at a lower level. All right. One more time back to the ES and the dollar index. ES, like we said, right at resistance. Yesterday's high or today's low will tell me whether we're going to be bullish for the next couple of weeks or bearish for the next couple of weeks. So look at the dollar index, and as big as the sell-off was in the dollar compared to other currencies, you can still see it's a higher high and higher low near term, or at least a higher high, and could set up for a higher low near term, and we still are in this long-term, very long-term uptrend. And so I'm not betting against the dollar yet. Just because we had one day down, and certainly because we could be setting up for lower highs in this consolidation, I'm still not betting against the dollar until we see a shift in commodities, until we see prices go back up, until we see some major shift globally economically from the Eurozone or from the pound or someone else that's showing more stability than the U.S. is. Otherwise, the U.S. will still be that safe harbor. And that's where I'd look for things to continue to hold up for the dollar. Just look for bounces and a continuation to the top side. Is New Zealand having a dry year? Yeah. Yeah, and it's not a bad idea, Dow. Water companies, As long as they have some value in there, as long as they have some earnings. I know that we're going to be restricted this year. So, one of our driest weather years in a long time. All right. Well, my friend, we are out of time, believe it or not. And there is for those asking about the market forecast, there is in the archives under the shadowtrader.net archives, there is one on market forecast if you want to go watch that, and we'll work it in the next couple of weeks. Thanks for being here. Have a fantastic week. We will look forward to same time, same place, 4:15 next week. And on the Aussie New Zealand, throw that one on. The Aussie New Zealand is reversed there. You can see weakness in gold and is outpacing the bounce in agriculture, and that's pushing this continuation potentially down. But I kind of want to see it clear the lows near parity. That could be bearishness for the Aussie, strength for the New Zealand. That would also fit with gold falling, no inflation, but agriculture prices stabilizing. So, all right. This will be posted. It's going to be posted a little bit later. I've got to run, so it'll be posted a little later. Have a fantastic week. It's definitely going to rain on us today and tomorrow, so hopefully we'll get some more water. Hopefully everybody else that's getting a drought, have some water. My best wishes to you all in the water markets. There we go. Have a great weekend, or a great week. We'll talk to you next week. Same time, same place.